I think reality is where rates are at today. I think it's a great opportunity, right? You hear over and over that, the wealth effect is driven by, your real estate ownership. The younger you are, the younger you can get in, the younger you can save, the better off you're going to be. I think a lot of the young kids, they're like, I'll never be able to afford a home. That's not true, right? You need to kind of plan. I think the average age first-time buyers probably moved itself up. It used to be probably 30, 31. I don't know the exact data, but I'm going to guess like 35, 36 now.
Yes.
There is hope, but it requires planning. And if you're committed to and you surround yourself with the right people, you'll get to the finish line.
What is more powerful, a lower purchase price or a lower interest rate?
Lower interest rate. Yeah,
That's right.
As a buyer, and I have 2 homes that I'm looking at, and one's giving me a concession and one's not, and I can utilize that concession somehow.
Yeah.
Right? We're all different in how we want to use it. I think that's got a lot of value to me.
So if you've got somebody who's thinking about a career in mortgage, if your kid's asking you that, what kind of advice do you give?
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, everybody, we are back for another edition of The Blueprint. Today I am bringing you a very dear friend who he and I have known each other for quite some time. He is a true veteran and mortgage professional in the industry, primarily on the wholesale side of things for his entire career, and I'll explain what that is to you. But I want to welcome Adelfo Emanuele.
Hey, Brad, how are you?
Yeah, man. Thanks for joining me today.
You.
Let me tell you a little bit about Adelfo. So he, like I said, he's a veteran. He's a seasoned professional in mortgages, over 30 years of lending experience. He is currently the regional manager for Dart Bank, and we'll talk a little bit about Dart Bank because they're pretty unique in this space. And he leads business development and client relationships across the entire western region of the United States. But previously, he was in leadership roles at the Texas Capital Bank and Home Point Financial that became public while you were there.
Yes, sir.
But basically, his experience, his origination experience, marketing experience, his knowledge about loans and the history of loans has been really instrumental for the people that he works with, specifically loan officers that send loans to the bank or have worked with Adelfo for many years. And I wanted to bring that expertise to you guys directly. So we're going to talk a lot about different loan products, qualifying for loans, maybe even the evolution of loans and where they were before and where they are today, so that you can, if you're in the market, either for a purchase or a refinance, you can learn a little bit something about how mortgages work and mortgage products work. That's really the purpose of today. And so, Adelfo, man, thanks for joining me.
Thank you, Brad. Appreciate it.
Right on. Thanks for driving up, too.
It was a little bit of a journey, but we're good.
Yeah, not too bad. All right. So let's start with just your history. Why don't you go back? It's 30 years, a little more than 30 years?
35 years.
Okay.
Been very, very fortunate to have worked with some large financial institutions, Chase, Bank of America, ABN AMRO. Been fortunate to be part of, some startups, including, the Dart Bank startup. Was very early on with Cole Taylor, was very early on at Texas Capital. Building a business from scratch is very rewarding because you get to kind of paint your own canvas.
Yep.
So I've been fortunate to be involved in those and have input on, what the canvas looks like.
Yeah, and that's been really part of your entire career is you've gone to these institutions, really actually unique in that not only have you gone to these institutions when they start out, but the vast majority of them have grown into very big organizations. So you were there at the very beginning, then you become kind of the OG in the company.
Yep.
And but you're used to that and you're doing it again.
Yes.
And
correct.
so let's talk a little bit about like how product has evolved over the years. Because you talked about, back in the day when you were Chase and ABN AMRO, which by the way, ABN AMRO, for those of you that don't know, Michigan-based company, giant, they did wholesale through the name InterFirst, which was, I don't even know if our paths crossed back then.
No, they didn't.
But I knew Willie Newman, who was the CEO, and that sort of thing. And so that whole career path, because you've been with him even at Homecomings, or Home Point rather, Home Point Financial, that whole kind of world out there changed the industry, because InterFirst and their innovativeness brought technology
Bingo.
that nobody else had prior to that to brokers and enabled brokers to become lenders.
Yes.
And they were the first one. They actually took me from broker to lender back in 2000, probably 2001.
Yeah, that's about one.
And they would train people to do that. There were other companies that were doing it, but they just did it really well.
Yeah.
And so let's talk a little bit about the product that existed then versus now, because in the early 2000s, we had conventional loans, Fannie Mae, Freddie Mac, FHA, VA, and then a different breed of product started to emerge. What was that?
Well, the subprime world.
Yep.
And 80% of the business we as lenders do industry-wide is still your fixed rate bread and butter, as we call it, right? These ancillary products become a small percentage. And that's what was kind of sad about, the financial meltdown, is you had a very small percentage impact a very large market. But as gone, through the 35 years that we've done this, the fixed rate has always really been the product of choice for the consumer, with variations of it, buydowns, temporary buydowns, long-term buydowns, things of that nature. The difference, I think, back in the early 2000s, ARM products were 20-25% of total funded volume, 5-year, 7-year, 3-year, which are great loans. I think one of the things that I try to emphasize to folks is the right loan for the right borrower.
Yep.
Okay. And as I talk to my loan officers, we talk about the right loan for the right borrower. Unfortunately, with kind of the financial crisis that occurred in 07, 08, the word ARM almost became a bad word.
Yeah.
And it shouldn't be, because ARM products are good products for the right borrower.
Yep.
And we're seeing kind of a resurrection again, resurrection, where we're seeing the ARM products become flavorful again. And that's exciting. Qualifying benefits. If you're not planning on living in a home for more than 30 years, why would you want 30 years? There's certain spreads that you need to look at to make sure if the ARM is something worth your while. So, if a 30-year is 3/8 to a half in rate higher, then you look at a 7-year, 5-year product. So there's different things that we try to coach loan officers through to understand right product for the right borrower.
Let's drill down on that just a minute, because I want people that are listening to this at varying levels of expertise to understand. So first of all, when we talk about ARM, what is an ARM?
So you're going to have a product that is fixed for 7 years, and at the end of the 7 years, you got an index and margin, and those two numbers are added together to determine what your rate for the next year is.
Give us an example.
So, for example, the products that are out there today, the indice on it is, I believe, like 4.5, and it's got a 2.5 margin. Okay, so let's say you have a 5.5 start rate today, and let's say your 7 years is up. At that point, you're going to add the 4.5 to the 2.5. That becomes your effective rate. So that number is going to be 6%.
Right.
7%. I'm sorry. So that's the adjustment. So most people never make it to the adjustment. I think the numbers show that it's single digits actually get to the point where their ARM adjusts, because they'll go back into another fixed product. Refinance, whether it be a 5-year, 7-year, or a 30-year at that point, right? It's all dependent on where they are in life. So an ARM is typically the first number you'll see is that's the fixed duration.
Right.
So some people are afraid that it's going to adjust every month. It's not like that. It's either fixed for 5 years, fixed for 7 years. At the end of that is when you go into an adjustable rate mortgage that can adjust on an annualized basis.
Right. Now, they're not all annualized. So let's kind of really break this down. So for people to understand, when we talk about fixed versus ARM, ARM is just an abbreviation for adjustable rate mortgage.
Yes.
Okay. And when Adelfo mentions there's an index plus a margin. So the index would be something like, and we used to do these on now it's a SOFR, S-O-F-R, another acronym. We do all sorts of acronyms in this business. It used to be the LIBOR, there's the T-bill, there's all sorts of cost of funds index, a coffee, prime rate, which is not typically used for first trust deeds, but for second trust deeds, they go by the prime rate for HELOCs. Yep. But those are indexes, and they can be tracked through the Wall Street Journal, online. And then you've got a margin. Now, that margin is actually associated with the note of your loan. So it's fixed.
Yes.
It's part of your loan. You can read it in your loan documents. Usually it could be 2%,
2.5%.
2.5%, maybe as high as 3% in some cases in HELOCs and so forth. But you add those together to give you your true note rate. So you'll have a start rate in an adjustable rate mortgage, which is when we're talking about an interim arm, which is something that's fixed for a period of time, then becomes an adjustable rate mortgage. So if we're talking about a 3-1, 5-1, 7-1, the 3, 5, and 7 are the fixed period, right? And so that is whatever the rate is that you're given
During
for that starting rate.
Yes, sir.
Then at the end of that is when the adjustment would take place. And then so tell us again how that works, because every loan has a first adjustment cap and then a periodic adjustment cap, and then there's a floor and a ceiling, right?
I'd say if you're considering joining the AmeriFund team, it's a really good idea.
We as processors at AmeriFund Home Loans support the loan officers in every aspect of the loan once it comes into processing, because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers.
If you're interested in joining the AmeriFund team, go to amerifund.com/careers.
Your floor is going to, and variations, right? I mean, you got different products. So a lot of times your floor rate will be your start rate. So you cannot go any lower than what you started at. Some loans have a margin as the floor rate, okay? So if rates go to 0, you're not going to go to 0. You're going to go rate 0 plus your 2.5 margin. So there's different variations. Very important for you to read your note. You made that comment earlier. The first adjustment typically can only go up 2%. So we're going to use that 5.5% example that we used earlier. So worst case scenario, the market goes sideways and my indice goes to 6 and my margin's 2.5. I'm not going to go to 8.5. I'm going to go start rate plus 2.
Yeah.
Okay. That's the cap on it. A lot of them have life caps of 5 above start rate. So I cannot exceed 10.5 as my total numbers. Those are important to know because again, folks are kind of petrified of this can go through the roof. No, It's got limits on how much you can move annualized and how much you can move life of loan. Those are designed to not put anybody in jeopardy, right? You should be able to buffer a 2% increase to your rate without it impacting your ability to afford your home.
That's perfect.
And then it's kind of subsequently goes up a little bit to where you should never be in a situation of jeopardy the way the caps are on the ARM loans.
Right. And by the way, they're not all just annual adjustments. Some are 6 months.
Yeah.
And so paying attention to those numbers
Absolutely.
when they can adjust and by how much is important. But here's the significant thing you said, and that is most people don't even get to the adjustment period because there's so many of them that either sell and move and they pay off that loan, or they refinance. In a period of time like we're in today, we're at the end of 2025, interest rates have come down from their highs, and we're definitely in a rate decreasing environment.
Absolutely.
What you get is you get a lower start rate than you would on a fixed. That gives you more buying power, lower payment, right? And the opportunity, if rates do continue to go down as expected, to refinance into a lower rate and hopefully even a lower fixed rate at some point in the future. So if you think that rates are going to go down, why not get an adjustable rate mortgage today, get the lower rate to begin with, let rates come down, and then refinance into a lower rate? Is that the right strategy? Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show.
Absolutely. I think buying a home and, the expenses that come with it, we can do some math here, but substantial savings on a 0.5% difference in rate, and that money can be used towards whether it's rehabbing the property, whether it's buying furniture, just kind of getting acclimated back into being a homeowner. I'm a fan. I mean, I bought my first house. I had an ARM. until I know how to use them. I think, the thing that I stress to folks is understand, read the note. I mean, we've said that a few times, because if you understand it, you can prepare yourself for where you're going to be. If you don't understand it, that's when you kind of get that
That's right.
paper that goes, wait a minute, and you're like, whoa, what happened here?
You need to be working with somebody that really does break
yes.
it down and educate you on it. But assuming that you do, and like you said, by the way, I had arms on my loans all the way until 2020, 2021, when rates were so low, you just couldn't avoid just get the fixed rate. But it's a tool. And it's been used by folks in the super jumbo world. So these are loan amounts that are above the caps for Fannie Mae and Freddie Mac and so forth. Banks give very large loans to very wealthy people, and they're almost always adjustable rate mortgages, which carry a lower interest rate because they understand the value of not paying the higher rate to the bank, taking that savings because they'll just refinance it later. It's used in commercial loans. It's used on commercial buildings. So these are things to just consider. It doesn't mean it's the right product for you. A lot of people are very conservative. They never want to even think about a change in the future. But if you understand it, it could really give you a lot of savings. So again, thank you for sharing that, because I think it's important that somebody who's a veteran in this business really break down what adjustables are in a period of time where we're finally seeing them again. There was an inverted rate yield curve that really made fixed rates lower than adjustables forever, and we're right now just emerging out of that where we're seeing adjustables again.
We've gone from a high of, let's call it 22%, and I'm going to say that was in 2002, 2003.
Yeah.
We went down to 1%, let's say 2015. Numbers up to 8, 9% right now, and I think it has a lot to do with us lenders explaining them to the loan officers. If you were in this business in 2000, you knew them, like you said. But if you got into this business after,
you don't even know adjustables.
So on our side of the fence, as lenders, we're trying to educate your loan officers on the benefits here, how you write borrower, write loan, how you sell them, how you educate the population. There's buydowns on ARMs now.
Yep.
And kind of going back to that example of getting a 7-year at 5.5. If you can get a seller to give you a concession to buy the rate down, you have a 1-year payment at 3.5.
Yeah.
And again, that goes back to you buy a home and you need furniture and you need rehab and all that. That's going to give you a nice flexibility to have that to get the home to where exactly you want it to be.
Yeah, that's a really good point. You're right. Look, adjustable rates haven't really been part of the market for a long time. I'm surprised to hear they're at 8 or 9% of the market now, which is bigger than I thought. But as that tool and with the buydowns, so explain what a buydown is real quick. So you said getting a seller contribution to buy down the rate. We're talking about a temporary buydown. What does that mean?
A temporary buydown is you're essentially paying for the interest up front, okay? And that's where a seller concession comes in. I think in the real estate community, if there's a home that's not selling and you have a motivated buyer, sometimes you'll give them something to help them with the transaction. That's called a concession, okay? So a seller concession. And what you're doing with buydowns is essentially calculate, let's say the rate's 5.5, okay? So you're calculating the difference in payment for the first year between 5.5 and 3.5. Then you're going to the second year and calculating the difference in payment from 5.5 to 4.5 because you're going up 1% every year. That number is the number you're going to use to buy your rate down, okay? The highest rate you're going to have is 5.5 for the remaining 28 years on your loan, okay? Or 7 or 5 or however many years. Buydowns are a big component in all aspects right now, just because we see sellers willing to contribute concessions to buyers to help them out.
Yeah.
They're great on ARMs. Again, you can go as low as 3.5. And some people might say it's a gimmick, but we're out there, we're doing them, we're funding those loans. Customers, I believe, that really understand how to sell the loans are doing a fabulous job. I think as a consumer, when you're talking to loan originators, loan officers, I think it's their responsibility to give you every possible option to fit your individual financial needs. And we're starting to see more and more in that, and we're starting to see more education on these products. And we're seeing more of activity on them.
Yeah. What do you say, though, to a seller that's being asked to pay some large sum of money for the buyer's closing costs as concessions?
Oh, God, I've thought about that. How do you convince somebody to actually give you something? Talking to realtors, I think, instead of reducing the price to purchase in the market, which is kind of setting the tone for a lower level. Let's keep the price at a certain level and let's give something, right? I don't know if realtors really want to be the first one to lower values in a community. And that's some of the tricks that they're using to get us, $8, $9, $10, $12,000 to do a buy down.
Yeah.
And it's an enticement for the buyer, right?
Yep.
That's
Well, I'll tell you, this is not something new.
Right.
Okay, and
It's been
all
going on for
I have to
years.
do is say this and people will understand. If you've ever shopped for a new home, you've gone to a new home builder, or you're currently doing that,
Mm-hmm.
have you ever heard of concessions to pay for upgrades?
Mm-hmm.
So builders don't want to lower prices. If they lower the prices on the homes, it's going to affect every sale subsequent to that. And not only that, here's what it really affects: the people that already bought.
Absolutely.
So if you have somebody that bought a home 3 months ago, and let's use some round numbers. They bought a home for $500,000 from a builder 3 months ago, and the market has softened. And the builder goes, okay, well, let's put them on sale. We'll sell them for $450 instead of
Just to value
$500.
the whole community.
Those people are not going to be happy,
Yeah.
right? There's going to be a major problem. So what do? This happened since the dawn of time. They leave the price, but they offer more concessions. You want upgrades? We'll do your upgrades. Now, remember, from a builder's perspective, it's not really dollar for dollar. They've got margin and upgrades, but either way. So if you drove, you remember driving in my city here through the 118 comes through Simi Valley, and on the right side, right as you enter, you see a sign with these new homes that are there. And what do you see on that sign? What did you pay attention?
I did, but I'm
so
sure
you
there
see
was builder concessions as part of the
$100,000 of concessions. That wasn't there 2 weeks ago.
Right.
So we're not going to lower our price, but we're going to increase our concessions. So the same thing can be used for sellers, and agents have to educate their sellers to say, hey, look, we're going to get as close to or maybe above our asking price. We're going to keep the prices in the neighborhood at a level that people have gotten used to, instead of your neighbor then wanting to sell their house and having to drop the price, and you get into this whole thing. But let's pay for some closing costs. Let's make it more affordable. Let's pay a buy down for your buyer to make it more affordable to them, because what is more powerful, a lower purchase price or a lower interest rate?
lower payment, lower interest rate. Yeah,
That's
I
right.
mean, as a buyer, and I have two homes that I'm looking at, and one's giving me a concession and one's not, and I can utilize that concession somehow, right?
Yep.
And we're all different on how we want to use it. I think that's got a lot of value to me.
Yeah, and these are really just numbers. So I'll give you a really great example. So we have a buyer that we're working with right now. They're looking at a home, and the asking price on the home is $925,000.
Good.
Okay, $925,000. This buyer is just barely getting in. They really should be buying a home around $750,000 to $800,000, but they fell in love with this home. It's in the community they've always wanted. It's got a pool. It's beautiful. There's nothing to do. It's absolutely perfect for them. But they're afraid because it's more money. We help them to understand getting a $25,000 concession and going up to $950,000 actually save them where their price, that the monthly payment that they have is lower than if they bought the $850,000 home.
With a buy down.
With the buy down.
Yeah.
And so in looking at them, by the way, we actually used a 5-1 arm and a buy down.
Good.
So we piggyback those. They're going to wind up in the high 3s for the first year, then in the 4s, and then in the 5s. And they're upwardly modal, so they're making more money every year as well. It's just a perfect fit for them, the right loan for the right buyer, and it gets them into a home that they really wouldn't have been able to otherwise. And so these are the tools that we're deploying today, and people need to be educated on this in order to help them, because we do hear it's not affordable, it's not affordable, it's not affordable. When you explain it, and these folks did understand, for every $1,000 in purchase price that you paid, so you paid $25,000 over asking, it was only costing them $6.50 per thousand.
Yeah.
That's it.
Yeah.
It was just under $6.50 per thousand. They're like, that's it? Yeah, but guess what? Now you also have a tax benefit. That interest portion, you're going to pay that.
Right.
That interest portion, or the increase in the property taxes, even the mortgage insurance now, right, with the big beautiful bill.
Right.
In 2026,
Write off,
we can write off the mortgage insurance costs. So those are tax deductible. So it's not even 6.5%.
Right.
They're in about a 40% tax bracket.
Yeah.
It's more like $4 a month extra for each $1,000. But when they really understood what the numbers were, it was a lot easier to make the decision. We should buy our dream home.
We both have kids, and I think the one thing I challenge my son with is math.
Yeah.
Everything's a math equation.
Yep.
And as you start equating the math, it helps you with your decision, because if it's different, it's negative perception, right? But once you break down the math, it changes your perception on things. And again, I think that's where it is with ARMs, right? A 0.5% on a $700,000 loan over 7 years, and I don't have my calculator with me, but that's a decent amount of money that you're not giving to a bank in interest.
That's right.
And again, the math equation makes you understand, am I taking the risk? Because there is a risk, right? You take the risk that if rates go up, then but there's a math equation that helps you with that.
That's right. Because look, even if it did go up and you had the savings for 5 years, even if it went up for 2 years after that or 3 years, your savings paid for the increase. And so there's the break-even point is further out than that 5-year period.
I think just in, we're in the business and we see some of the things that are out there, but I think from the consumer perspective, all they really know and understand is 30-year fixed. And to some degree, I think we, from media perspective, has scared them into this is all you should ever get. And if that's what, but at least be open to other opportunities that are out there that can help you buy in a bigger community, a better community. Because you're right, everybody's affordability index is stretched to the limit.
That's right.
And if you truly find something that you're in love with and you're open to alternatives, we can help you buy that dream home, maintain the payment that you're comfortable with. It's going to be a little bit creative, but we're going to get you there.
That's right. That's right. Let's dovetail that into the tax benefits of buying a home, because most people don't really understand that side of it.
Right.
We talk about deductible payments. So there's 3 different facets to your monthly mortgage payment that can be used as a tax deduction.
P&I, principal interest.
Actually, just the interest portion.
Interest portion, right?
Right, of your mortgage payment.
Absolutely.
And the second.
Your taxes.
And the third.
Your mortgage insurance.
Mortgage insurance now, which didn't exist before.
Didn't have,
Right, so starting in 2026, you can deduct mortgage insurance payments as well. So what does that mean when you're told you have deductible payments and that's going to save you money? What does that exactly mean for a home buyer?
It reduces your net taxable income. So if your taxable income is $100,000 and you're showing $15,000 in expenses, right? Your percentage of tax is going to be $85,000 instead of $100,000.
That's right. So you're no longer paying tax on that $15,000 of deductible expenses. And if you're in a 40% tax bracket, let's just say, for example,
that could be
and that's $7,000 or so of payments that you would otherwise be paying the government in tax.
That's $600 a month, give or take, right?
That's $600 a month. So even though maybe your payment is higher than what you're paying for rent, when you take that into account and you reduce it, maybe it's the same.
And that's another thing that I talk about a lot is, the net component of getting to where you need to be.
But most originators don't explain that to their borrowers. And then the buyers don't go to their accountant to understand it. And so their very first year, they go to file their taxes, and what happens? They get a giant refund.
Right. They're surprised by how it worked out.
Wait, what happened? Yeah. I struggled all year and I got this giant refund. Well, take the refund, divide it up monthly, and have your cash flow pay for the extra cost. And that's a tool that should be deployed more.
I guess I was fortunate that as I first got into the business, a lot of my friends were buying homes, so I would kind of coach them. And the things that I would say is talk to your accountant, talk to your insurance person, make sure you get with a mortgage person that's going to give you every possible opportunity that's best for you. I don't know if a lot of people do that today. Now that I'm seeing my friends' kids buy homes, sons and daughters, I try to share the same information with them as, math, right?
Yeah.
Break it down into mathematical process, understand the tax benefits that come with it, because it's not what you think it is. The number they're putting out you is your obligated number, but then your net number is going to be something substantially different. And some embrace it, right? Some don't. But there's a huge tax benefit of being a homeownership.
That's right. Yeah, and if they don't, let's say, embrace that or understand it or set up their deductions so that
Properly.
they have an additional amount of cash, net on their paycheck every month to make the payment, they realize it after the first year.
Absolutely.
That's when you realize, wait a minute, I got a big deduction this year. I didn't expect that. All right, so listen, let's talk a little bit about Dart Bank.
Yeah.
Because you went to you called it a startup.
Yep, startup.
Okay, but it's a startup in mortgage.
Startup and mortgage folks, we're all seasoned, we're all tenured, we've all done this a long time. We've all been part of, startups. I think the beauty of a startup, and I think we were talking about this today earlier, is you kind of get to paint your own picture.
Yep.
Where we're able to look at our tech stack, look at what's there. I think the mortgage industry has become everybody uses the same. If you look at 80% of the mortgage business, it's running on or near the same platforms.
Yeah.
And sometimes you get stuck in these systems. Mm-hmm. It's so expensive for you to get out of them that you just keep. And starting from scratch allows us kind of a clean break to look at things, reevaluate vendors, really evaluate cost of items that we need to function. So we feel that our cost to originate a loan is much better than what our competition is because our tech stack is fresh, new.
Yeah.
It's new items. So that obviously gives us the launching power to kind of, take it. You have to kind of go in steps, right? You can't go from 0 to 1,000. You go from 0 to 10 to 20 to 30. So the business started out in January of 24. It took us about 8 months to get to the point where we physically were licensed. Our platforms are in place. So we opened the doors in August of 24. So we just had our year anniversary. We're doing good. We're doing okay. I mean, we expect to be where we are. There's some growing pains that kind of come with it, but we've done this before.
Yeah. What's the volume you guys are doing today?
We're probably in that $80 to $100 million a month range, and look to increase that.
Yeah.
That's a good accomplishment. Profitability.
Well, you guys, look, what you said about having the correct tech stacks and being really efficient. You've basically been able to lower your interest rates to attract business by doing that.
Absolutely.
So you guys have fantastic rates, and so if you're working with, we talk about this a lot on the show. People say, how do I get started to buy a home? And we say, look, you think you want to go talk to a real estate agent first, but that's really not the thing to do. You got to talk to a mortgage originator. You got to find out what you qualify for, feel comfortable with the numbers, and then when you're out there looking, you can actually write an offer when you find that house that you fall in love with. But I also specify that you've got to work with an originator, a broker, that is 100% commission, because they're the most invested in your success. They're the most motivated to do that, and they have the most options. So when we talk about working with a company like Dart, like we're approved with you, we're approved with 75 different lenders, and every lender has a different niche that they concentrate on. It might be a non-QM, it might be chattel loans, it might be renovation loans, might be other things, but then you've got a grouping of like a lot of overlap. And what separates the lenders from the others if they're doing the exact same product? Pricing.
Yeah.
Pricing and the ability to close painlessly. Because a lot of lenders make it very difficult, and there are very few that make it really easy. So you don't want to wind up disappointing people, closing late, or asking for more and more documentation and things of this nature. You want to make it as easy as possible at the best price, and finding that happy medium is really important. And you guys are right there.
Good, we appreciate that.
Yeah.
I think I say this a lot as I talk to younger folks that are getting into the business and all that. Going back, and we won't date ourselves again, it was a relationship sell, right? So Brad worked with me because Brad trusted that I was going to get him to the finish line. Where back then I think AmeriFund had 4, maybe 5 primary places that it drove its business through. Today it has become a commodity sell.
Yeah.
And the only way you garner somebody's attention is price.
Yeah.
Again, back then you'd go into an office, they had their board with all their loans, they were at 4 or 5 places. You go in today and they've got 20 loans at 20 different places.
Yeah.
And as you ask how come, it's a commodity. I had to go to the lowest execution. I think we're in an environment right now where we probably have an overcapacity of originators. So that consumer, which is good for the consumer today, has the opportunity to shop, and they're going to go commodity. They're going to take the lowest common denominator to get to the finish line, right? So it's a very, very price-sensitive environment where you have to originate at reduce to create that commodity on the rate sheet, and that's where success is.
Yeah, I agree with you. And that is the first thing that gets looked at. I mean, we have tools that shop the rate for the loans. We have the loan parameters. We have everything in a system.
Pops
and you
up.
push a button, and it tells you everybody's rates. And it tells you what you can get at every lender. And you don't want to work with somebody that's always sending their loans to the same lender. It means they're not shopping the rate for you.
No, yeah, absolutely.
It means they're not shopping it.
Absolutely.
And so if you are working with somebody and they're spreading it out, now that doesn't mean that maybe for a month straight, Dart's the best price, and you wind up getting all those loans in that month. Well, that was because you had the best price about the market. But if it's that way for a year or 2 years or 3 years, then there's something wrong with that. And so
Absolutely.
it's really important for consumers to understand that.
And we as lenders want you to, share your business. We think it's good to support our competition, and we want it to be a healthy environment. We're not into, you can only send loans to X place, right?
Yeah.
We want you to work with our competitors, because the healthier the environment is, the better we all perform. We all make each other better, which leads to the resources we give you.
Yeah, I couldn't agree more. All right, let's talk about somebody that might want to become a loan officer.
Wow.
So, yeah, I know, right? Very interesting. I was at the gym, and the manager at the gym came up to me. And, hey, I don't know how much longer I'm going to be here. I'm really looking for a career. What are you looking to do? What are your skills? All that sort of thing. Well, I was thinking about real estate, but I don't know if I like selling real estate. Are you, what are you good at? Well, I'm really good with numbers. I'm really good with people. I'm good with sales. Have you ever thought about becoming a loan officer? Well, I have thought about it, but I don't even know where to start. So let's talk about that as a career, right? And so, and we can kind of go through the years of this as well, because in the 90s, when I started in the early 90s, if you said you were a mortgage broker, a mortgage professional, it was really like a professional. Like it was a badge of honor. It was like being a stockbroker. It was like
You're a banker.
Yeah, you were looked at as a certain way. Then, as we got, kind of to the end of the 90s, the beginning of the 2000s, then you started to see all these reality programs coming out, and you saw like a 21-year-old girl that was still going to college who said she's a mortgage broker. I mean, and then you just on all these reality shows, oh, what do you do? I'm a mortgage broker. I'm a mortgage broker. I'm a broker. And you saw it everywhere, and it just lost its luster. And you just no longer were like really a professional. It was almost embarrassing to say that for a while. And I think you can relate.
Yeah.
Then we got the brunt.
Right, and it went bad on us,
Yeah, in 2007, 2008, during the mortgage meltdown, all fingers pointed to the originators, which were just pawns. We know that because we're in the business. You had to do the loans that were given to you by the lenders that they were providing the product. We didn't design the product. We were selling the product that you were buying. That was it.
Right.
But now it's become a lot more difficult to get your license, to maintain your license. There's a lot more scrutiny.
Effort,
Your license is tied to every loan that you do. So anybody that pulls up a loan can see who the originator was. So there's a lot of tracking. It's kind of regained its professionalism, if you will.
Yeah.
And it's a lot more difficult to get your license and to keep your license. So if you've got somebody who's thinking about a career in mortgage, if your kid's asking you that, what kind of advice do you give them?
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
Don't do it for the money. It's a very rewarding career, but you have to do it because you love helping people. I think there's too many people that focus on the dollar aspect of it and don't focus on the quality of it. I mean, to me, Friday night, I know 4 people moving into their homes this weekend, 5 people, 10 people, and I had a lot to do with it, and they don't know who I am. You have to love helping people. That's number one, okay? Because a lot of people that want to get into this talk about how much money they can make, and I think that's the wrong idea, right? So number one, I want to help people. Number two, you need to probably mentor up with somebody who you deem to be a mentor, successful, and work with them for a while to learn things. I think just I'm getting my license, I'm going to go work over here, I have no background, no mentor, no nothing, is a recipe for failure. I think you walk in, you shadow somebody, you watch what they do, and then at some point, you kind of come to the realization, is this what I want to do, and am I ready to go off on my own? We put electricians through apprentice programs, correct? And I guess that's kind of what I'm suggesting to folks that want to get into it, is figure out a way to apprentice, because the skills that I've learned, that you've learned, that a lot of our friends have learned, it took us 20 years, 30 years to learn them.
That's right.
You and I can sit down and talk about a loan and know how to fix a problem, okay? Didn't have that skill day one, right? And I think loan officers, that's probably the best skill they could have, is the ability to look at something, fix it, or communicate with somebody to fix it. So starting off in the business, number one, love of people, wanted to help people. Number two, who can I shadow to help me? And number three, where do I go when I need help?
Right.
I think that's the advice to get to where you could be successful. But again, I think in many cases, I get my license, I show up at a desk, they give me business cards. Who's helping me?
Yeah.
The failure rate's high.
It is.
And the failure rate's high because they don't have anybody really guiding them. And I talk to a lot of my customers about this as, having mentoring programs to bring kids in, young folks, or even folks that are in career change, right? And kind of taking them through the steps of understanding how to be good.
Yeah.
I mean, it's okay just to be a loan officer, but I want you to be a good loan officer.
Yeah, look, I think that's pretty decent advice. First of all, you got to really love what you do.
Yes.
Okay? And it's the old adage, if you love what you do for work, if you love what you do, you'll never work a day of your life, right? So that's number one. But the second is that passion has to come from knowing inside and out and really knowing what you're doing. And the only way you really get that is by doing it, because you can't get it from a classroom.
No.
There's not a loan that I get or I see that doesn't have a nuance to it after 33 years in the business, that doesn't have a nuance I've never seen before.
Right.
Like it's crazy, all the different scenarios and problem solving for that. And you can only do that if you have the experience. Well, the way you gain that is through a mentor, like you said. So I think having mentorship, absolutely critical.
Yeah.
But really, the steps are kind of cumbersome to begin with, because in order to get your license, you've got to take courses. You've got to pass the courses,
and it's all new language.
And it's the nomenclature. Learning all the acronyms, learning what these things mean. Like it's learning a whole different language. There's no question about it. But then taking the exam is a whole different thing.
Yep.
So what you learn in the classes to pass the classes is not the same thing that you need to pass the exam. So now you got to take a course to learn how to take the test to then pass a test. And most people don't pass their first time.
Yep.
It sometimes takes 2 or 3 times. And
Absolutely.
why? Because they're kind of trick questions. You learn it, and then they rephrase it a little bit, and it looks like a familiar question, but the way they phrased it is a different answer, and you really got to pay attention to it. So, oh gosh, I got to learn how to take this test. So then you finally pass it, and you're still at square one. You haven't even got to start yet. And now you get the first person that says they're interested in a loan, and you don't even know what the heck to do. So having that mentor is really important. You got to expect that it will take at least a year.
Yeah.
Before you make any money.
Yeah.
At least a year.
Yep.
Right? And so you have to have staying power for that. And then it's the ups and downs of the business. It's the things that are out of your control. You have to be able to withstand a lot of stress. People not happy with you over things that you can't control. Communication is key. Sales, knowing numbers, being able to review numbers, speak confidently about numbers. I mean, there's so many different skills that go into a really good originator, and the difference between a good originator and one that's not so good is vast, right? You're talking about people that can't even afford a living versus people that are killing it.
Thriving. Yeah.
There's not that many in the middle.
You know, so I'm going to ask you a question because I want to hear your feedback. Is it harder to do the job today than it was in, let's throw out 1995? Is it more difficult today than it was back then?
I think there are aspects of it that are more difficult and aspects that are not as difficult. Let's start with those that are not as difficult. It's a lot easier to take a loan application today.
The technology
it's electronic. You're not driving out and sitting in front of people taking an application. It does happen on occasion,
some people,
but it's a link, and people are used to it, and they'll sign things through electronic docu-signing and all that sort of thing. So that's become a lot easier. I think where it's become difficult is the complexity of the loans. It's way more complex today, and there's not as many resources for solutions, and so there's a lot of let's say seeking a solution for your problem instead of putting your problem out there and letting the solution come to you. So just back in the day, having a loan scenario and being able to go, okay, here's my scenario, and being able to talk to 2 or 3 or 4 reps until you found one that had the perfect product for it. It's not like that anymore. Like, you might have to talk to 10 or 12 or 15 different reps with different products to find a solution. It's way more complex. So I think, like I said, some easier, some more difficult.
I think from the consumer touch interaction, way easier.
Yeah.
But, back then, guidelines were not posted. You had to physically find somebody to look things up for you.
Yeah.
Where now everything's kind of at the snap of a finger. So I think from a loan officer perspective, once they become who we ultimately want them to be, right, self-sufficient, understand things, they can look up guidelines with a blink of an eye. That wasn't a benefit back then.
You use chat now for it.
Chat GDP has done a great job if you just kind of say, hey, here's what I'm looking for. So there is aspects that are way easier for originator, but there's also aspects, like you said, finding the right solution price-wise and everything else too.
It's just scattered product. There's not, again, there was so much product overlap from lender to lender before, but now everybody's got a super niche.
Yep.
And we talked about this over lunch about the different niches. Oh, did you hear that this, credit union's doing what? They're doing what?
Yeah.
And they're the only ones doing that.
Right.
Well, I wouldn't even know if I had to borrow to fit. I wouldn't even know if I didn't expose myself to that particular lender and knowing what they offer, so that when I have a borrower that needs that, I know to go to them.
Or you can sell
How would
that
I know?
product. Yeah.
Yeah. And so I guess the lesson to the consumer is, just because your loan officer says they can't do something doesn't mean there's not another one that can.
Solution. Absolutely.
Right.
Yeah.
And so you want to definitely work with somebody who is knowledgeable and knows a lot, but they may not know everything.
No.
And so don't give up at that first talk when they say, no, you can't do this, or you need a co-borrower, or you need this. There may be another way to do it, and they just haven't discovered that.
Part of my meetings, I try to have lunch, contact, some sort of communication with all my business owners, right, like yourself, and different folks that actually own businesses. And part of that meeting is always what's going on out there.
Yeah.
Okay, because I'm trapped in my own little world sometimes, as we all are, right? We're all trapped in kind of our offices, and getting out and talking to people and finding out what other opportunities are out there in terms of products and what people are doing allows me to take those opportunities back to other partners and share that with them. So it's very rewarding for me to, do what we did today at lunch, right? Hey, did you know this?
Yeah.
So I try to add that into my meetings, because it's nice to sit down, have lunch,
you
with your family.
You exposed me to a product I didn't know before just by having that conversation. Where do you expect interest rates to go from here?
I think they're going to be flat. I think this is now globally things could occur that would really change the direction of that. And quite honestly, I feel that rates are appropriate right now for where the economy is and kind of everything else that's going on. I don't anticipate a huge drop down in rates. I don't anticipate a huge drop up in rates. Really no reason to. Again, historically, if we had rates like this, we would have been good. I think the market just got kind of spooked by, that 4%, 3% movement down that occurred, where that was unrealistic.
Yeah.
I think reality is where rates are at today. I think it's a great opportunity, right? You hear over and over that, the wealth effect is driven by, your real estate ownership. The younger you are, the younger you can get in, the younger you could save, the better off you're going to be. I think a lot of the young kids, they're like, I'll never be able to afford a home. That's not true, right? You need to kind of plan. I think the average age first-time buyers probably moved itself up. It used to be probably 30, 31. I don't know the exact data, but I'm going to guess like 35, 36 now.
I would guess.
There is hope, but it requires planning. It requires education. It requires you to talk to people, understand the net benefits of owning that home.
Yeah.
And if you're committed to and you surround yourself with the right people, you'll get to the finish line.
Yeah, and I think a lot of that also, if you really want to be a homeowner, is you got to be open-minded to moving to a place that's affordable.
Yeah.
And with us being a mobile economy, with people being able to work from home with many, many jobs, way more than they used to before, that you can move to areas that are way more affordable. There are beautiful areas, there are newer homes and all that where you can buy. If you live in Southern California and you think that the average home, let's say, is $850,000, $950,000, well, there are beautiful areas in other states that it's $350,000, right, and way more affordable. And if you have the ability to move and still be able to retain your position, or your job, or your income, and make it more affordable, well, maybe that's how you start. And people have to be open-minded to that.
And again, correct me if I think the mindset of talking to my son and his friends, I think you and I were brought up in a world where we had to have a big house with a big lawn, a big yard, and, big. That's not the mindset today. They want closer to transportation. They don't want to drive.
Yeah.
They want to live in the city because they want to walk too. So it'll be interesting to see what happens with new development and change and all that. If we still experience, growth east and west of Los Angeles, that's where we live. Or will we see a revitalization within the city to where you see more high-density housing? I think that's going to be kind of interesting over the next 15 years on how the landscape of housing potentially changes because my son, his friends don't want a yard. My son and his friends don't want to drive X.
Yeah.
They want to be to them, the ideal place to live would be New York City.
Yeah.
Where you walk out of your apartment and you go get some coffee and you go get some breakfast, you go get some lunch, you go to the gym, you walk back, you take the subway to go to a show. So that, again, that'll be the interesting part of how, the city transitions away from big suburbia to more of an urban living component. Because I do believe that is what the youth is kind of requesting.
Yeah, I do think you're right, and that's been happening for quite some time.
Yeah.
I think, though, today there's more people looking for larger properties than there were even just 6 years ago.
Okay.
But they're willing to go to the outskirts to get that, right? And so, but they do want the components of being able to walk places that are convenient, not have to drive 20 minutes to get to a nice restaurant, that type of thing. So they want a little bit of both. And I think builders are starting to realize that too. So you are seeing builders give a little bit more property in a lot of areas, on the outskirts.
Right.
Obviously, if you're in an urban area, they're trying to maximize and give you the smallest. But another great example of that is when you pulled into our city, those are half-acre lots. We weren't seeing half-acre lots just 5 years ago, 6 years ago, but they're going back to that, right? And so there's a lot changing. Here's what it's akin to. So there's always efficiencies, right? So that you can build larger homes at less per square foot, right? Well, I guess the same thing holds true for TVs. You walk in Costco now and you see a 91-inch TV for how much?
$900.
Not even that. It was less than $900. It's like $815 or something like that. I mean, it's unbelievable that the prices that are coming down on these larger, because they're thinking, okay, what does it cost them? Does it really cost them more to build? Right, it doesn't. Yeah. But there's more appeal. It's like bigger, it's better, right? And so I think a little of that's coming back. But yeah, it's ever changing, as you know, in this business.
Yep. It has to be. Yeah. I always kind of think about at some point I'm going to retire, right? And it's been fun. It's been fun. It's been rewarding. I've met a lot of great people. Been fortunate to have helped a lot of people get into homes. Anybody that's thinking about getting into this business, you're going to get a big thumbs up from me to do it. It's a good business. There's good people in it. It's rewarding. It's frustrating.
Yeah.
It's challenging.
It is all of that.
It's a little bit of everything thrown into a ball and spun around. And
all right, I've got a question for you that I'm hoping you can answer. What is the difference between subprime and non-QM?
It's just words. Yeah, it's just words. Basically, Fannie and Freddie agency loans, are basically insured by the government, right? Those are just insurance agencies. FHA is just an insurance agency. These products don't have insurance. So they're open market traded, if somebody defaults on it, the investor's not guaranteed, a return. And that's where agency products really have a backstop. Government loans have a backstop that if it defaults, somebody's picking up the claim, right? And non-QM, subprime, it's open market. The rates are a little bit higher. You got to generate a return to the investor. Again, right loan for the right person. Some of these loans are great for people. Some of them aren't. But to me, the difference between agency government loans, which again, like we said earlier, is about 80% of the business, and non-agency, let's use that word, right? Because it's subprime, non-QM, they're all non-agency. Just really means there's not really a backstop in the event of default, and that's what happened in the crisis, right? It wasn't really the agency loans, government loans that went sideways quickly. It was the non-agency stuff.
That's right.
The subprime that really and the investors took a hit because there was no backstop.
Yeah. And so you're saying that's the exact same as, and by the way, when we say non-QM, and I like how you put that non-agency, it's non-qualified mortgage.
Right.
So after the meltdown, the Dodd-Frank Act came out, and they set a line in the sand that said you could do a qualified mortgage that has backing or a non-qualified mortgage. And initially, everybody was afraid of doing non-qualified mortgages. There were almost none.
Yeah.
Right after that. And then slowly over the years, the product has expanded. And so when we talk about non-qualified mortgage, we're talking about alternative methods to qualify for a loan.
Yes.
So on your qualified, documentation-wise, so on your qualified mortgages, your Fannie, Freddie, your agency, your FHA, your VA government loans, you have to follow certain guidelines. They require that you document your income, that you have good credit, that you've got money in the bank, all these things, and there's nuances to all that. You get outside that, if you're self-employed, you're not really showing enough income, or you're buying investment property and you want what's called a DSCR, a debt service coverage ratio, where the income, the rental income makes that payment for you, or you've got assets but no income. You want to use your assets to qualify for the loan. When you get outside the box and you want these different ways of qualifying, those are non-qualified mortgages, non-QM, right?
Again, I go down there's two boxes for me. It's an agency loan or it's a non-agency loan. And that's really all. Everything has a ATR, ability to repay. Every loan has to show an ATR. That's a government
So when you say
regulation.
that's the biggest difference between non-QM and subprime, is ATR, ability to repay. Isn't that the biggest difference?
That's a great point. The subprime did not have a
component for ability to repay. That's why you had Nina's, no income, no asset. You had stated income. You had no income on the application. You just left it blank, right? So it didn't have the ability to repay.
I'm probably going to get shot by making this statement by somebody. Back in the days, the performance on a stated income versus a full doc was the same. Defaults. And the reason being is the stated income product, skin in the game. Very good. So typically you're requiring a 30% down payment. So these loans at LTVs that work, skin in the game, perform as well as fully documented loans.
That's right.
Is when the thing starts going sideways is when you start doing them at high loan to values, low down payments, where the borrower looks around.
And no credit requirements.
No credit requirements. So I think that's kind of been a bad word. Subprime, non-QM, all that. Everybody assumes that it's a higher risk loan. It's really not. I mean, if you're at the right LTV, regardless of what product you are, let's throw the names out, right? The LTV component creates the risk.
Yeah.
And it creates the default. So folks that put 50% down are not going to default.
Right.
Even if things go sideways, they will sell their house.
Yeah. When we roll, and so what you're referring to is like if we roll the clocks back to the first stated income loan. So
Yeah.
there were basically two banks providing stated
World
income
Savings.
loans. World Savings and
Downey Savings. I mean, there's
Coast
probably
Federal.
Coast Federal, yeah.
Okay. Those were the two.
That's
They
the
were the two
yeah.
major ones. But they required 25% down
Yep.
minimum. Okay. Most were at 30.
Yep.
They would go to 25 by exception. And the default rate was very, very low.
Yeah.
It was when the greed of Wall Street came in and said, no, we're going to start expanding the product. And they took that concept and started doing a higher loan to values, less skin in the game, no ability to repay.
Yep.
And then opened up the credit qualifying as well. So credit scores, they weren't. We'd credit underwrite before the credit scoring, right?
Yeah, I don't even
And then
think there
credit
was,
scoring
yeah.
started to come out, and that was the predictor of the ability or desire to repay,
Right.
I should say. And then they started to decline that. So that was the beginning of the end. That is not what we have with non-QM
Right.
because the token of what you said, we still have the components of skin in the game. We still are checking the credit to make sure that they are making payments on time and things of that nature. We're not going to super low credit scores and combining that with bank statement to qualify or assets to qualify. So it's not quite the same.
I think our industry right now is, I'm going to go back to 2005, right? In 2005, it was very similar to what I think today is. You had a lot of folks chasing the same loan, margins were tough, and these products were expanding. And as everybody got these products, the only real way for them to keep going was to keep expanding the credit box. I think to some degree we're at that piece right now, so it'll be interesting to see if that occurs or if we as an industry just kind of say, hey, look, here's the numbers and here's where we feel good and here's where we think defaults are going to be at an acceptable level, right? And if we're going to, because competition and margin and all the other things, to keep mortgage companies keep the doors open, they're going to start stretching the credit box.
Yeah.
And do we have the same phenomena? Again, I think today is very similar to where we were in 2005, and that's what happened in 2005.
How are the default rates today?
I just actually pulled something up that I don't mind sharing with you that it actually broke down per state. I think it's more state specific. I think it's county specific.
Are they higher than they were?
I don't know.
It?
I just looked at it. I took a snapshot of it on my phone. I don't know the answer to that.
Okay.
I haven't really drilled down to see, but I'll share that with you.
Okay.
I think certain markets, you talk about DSCR programs, certain markets got saturated with short-term rentals.
Yeah.
So when you have saturation, you have decrease in rents.
Yep.
So you were depending on that. So I know there's some places around the country that are struggling with that. But if you look at fully documented agency loans, I think the numbers are still good. I think there's a little bit of an uptick in low FICO government loans.
Yeah.
I don't think the defaults are anything we're not seeing foreclosures pop up on the streets.
Yeah, we're not.
I don't think we will. I think folks are still sitting on equity. They could sell their properties.
There's still high equity.
There's still high equity.
That's a big factor here.
Yeah.
And frankly, a lot of people that still have very low interest rates, and they're not going to chance giving those out.
Oh God, what's the math? Like 40% has 2.5 or less.
That's a
That's
lot.
why the home equity business is so big. I mean, that's
right.
a huge. It's another thing. If you got a 2.5 rate and you need to do some work on your home, contact your local mortgage professional and grab a second trustee for $20,000-$30,000
Or a HELOC.
or a HELOC or something like that, just to keep that first rate in there. So, I think the whole gist of what we've talked about today is be knowledgeable as a consumer, as a loan officer, right? Sell the right product to the right borrower as a loan officer. Understand your craft, understand what's out there, understand different opportunities to help folks. I think there's a mortgage for everybody, right?
Yeah.
If you wanna do it, we can help you somehow, some way. Again, it's a good time to be a homeowner. It's a good time to be a loan officer. I don't ever look at this as being a bad time. It's a great time.
Yeah. I love it. I love it, man. Yeah, it's a great summary. Hey, Adelfo, if somebody wanted to get a hold of you, they want some advice on loans and that sort of thing, how would they reach you?
My cell phone, probably the best way, or you can use my work email address. My cell phone's 317-0150. Feel free to call and ask any questions.
If you're an originator out there and you're not working with Dart Bank, you should reach out to Adelfo. He's a pro, and they do a really good job. Thanks for joining me today,
Thank
man.
you, Brad. Appreciate it.
Yeah. Hey, guys, again, thank you for watching us on The Blueprint or listening through your favorite audio station. But if you liked it, please follow, share, subscribe. All those things help us. We appreciate you tuning in. We'll see you next time on The Blueprint.